Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. Paris rapeseed. It must be close to 4 months now that I've been saying this, and I will gladly repeat it once again here. It was, and it still is. Still is sometimes a sheer joy to give commentaries here. Why? Because of the beauty of the patterns that show themselves, and Paris rapeseed daily chart continues to exhibit such a beauty of pattern here. There are still two key patterns. The first and larger one is the February 2021 to July 2022 ascending broadening wedge pattern. This has disappeared up off the top left corner of my daily chart. To be honest, it is a large but imperfect pattern, but yet it had been the main market driver here in the early part of 2022. The break lower in July last year left the following incredible targets on the downside, which I highlighted back at the time. The primary target X is in the 352 even area, the harder to reach secondary target X1 down in the 217 even area. These were, at the time, well, pretty much way out there targets that you could put into your diary on the back page and just look at maybe once or twice a year. Well, not so now. As you can easily see, target X towards the bottom of my daily chart. There was also, and still is, a newer, smaller pattern, though it deceivingly looks quite big on this daily chart. It is the early July to late October 2022 bearish Andrews pitchfork, and this is where the joy comes in. The market has since October last year moved down within this bearish pitchfork, mainly as it is now in between the middle time below, currently at 383, and the upper time above, currently at 453. You can clearly see the tines of this pitchfork as they are highlighted in purple on my daily chart. The only new feature in recent days has been the drop below the congestion between 438 to 446, resulting in a weekly key reversal down 4 weeks ago, as prices moved down towards the middle time, plus the emergence of some old support from two necklines, which are very close together, generated from the November 2019 to February 2020 move. They're at 399, highlighted in bright red, and 401, highlighted in green. These are also close to December 2020 low at 396. 3 weeks ago I said this would be the next area of support along with the middle time, and so it became over the last 3 weeks. Last week those two necklines were penetrated along with the December 2020 low, and we even opened below the middle time. But prices have quickly recovered enough that this week the market threatens overhead the congestion back again at 438 to 446, which has been now reinforced by what was a declining short medium moving average, currently 439 a quarter. And just under these resistances is where the market has stalled today, yesterday, and the day before. So we seem right now to be in between bands below and above. This cannot last, and I suspect it may see a move one way or another by the end of June. See, coming in from above is the upper time in purple, and this will intersect with the 438 to 446 resistance by the end of June, going into July. On top of that, coming in from above, we have the medium moving average, currently 479 and a quarter, coming into the frame, and into the congestion between 460 and a half to 468 and 3/4. It's the next area of congestion above. I will just finally recap the further supports that are below the middle time. I outlined these last week. They are varied and consist of not just the lows of March 2019 at 353 and a half and June 2018 at 352 and 3/4, as well as the April 2018 low at 340 and a half and March 2016 low at 336 and a half. But also the changeover gap from April into May 2018 between 346 to 351. However, first, we have a very shallow and almost double decade support. The 2005 to date uptrend, currently at 469 and 3/4. Winnipeg canola. Back in late summer last year, I said at the time, and I quote, "Became evident since the start of the sideways to slightly lower movement we've seen here since June that there was a shallow bear channel, currently that's between 860.60 and 748.40. And it is this that had been driving the market lower during the summer, end of quote. Now, to emphasize this point, I further added, and I quote, so it seems until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of the market, end of quote. Well, as you can see, the bear channel led the way lower and it was broken in mid-March. To help you see it, I've highlighted it in dark blue on my daily chart. The more recent targets below for the big bear channel pattern. Thus, the primary target and secondary targets for this move lower and out of the bear channel had already been reached in the 726 and 644.5 zones respectively. The drop went as far as reaching, or breaching I should say, the 2021 low at 629.5. However, in the middle of last week we saw a reactionary move back up. Yet this seems to be a reactionary move back up without any backup behind it right now, as it stalled at the very next resistance, the June 2021 low at 655.90. This brings you back to looking at levels below, and the next significant support is way below, down at the December 2020 low at 567 even. I'd have to go all the way back to February and March 2013 to see further congestion, and personally I do not think they are valid or appropriate right here. I'd now like to raise once again the final point I spoke about 22 weeks ago, and on every occasion since, and I quote, there is just the thought of what may be the whole April to date action. So that is April last, no, even last year, 2021 to date. It's April 2021 to date. Of what may be the whole April to date action. It can be seen as part of a very large bearish halfway hesitation. It's all still too early on these thoughts, but I think they need to be present when things start to happen, eventually, end of quote. We are no closer to this, but we are also no further away either at looking at this whole action as a possible very large bearish halfway hesitation. Thus we have a possible downside target X for such a pattern down in the 560 zone. This is another level that you can put in the back of your diary and look at every so often, just in case. The only issue is that it is now sitting at the bottom of my daily chart and is therefore a lot closer than some might imagine. Bursa Malaysia crude palm oil. In late 2022 we saw the construction of a new mid-August to early November 2022 mildly bearish shift pitchfork, which is highlighted in green on my daily chart. This mildly bearish pitchfork has guided prices, more or less, lower ever since. Initially it was in between the upper time, currently at 42.03, and the middle time, currently 35.70. Then 5 weeks ago prices tried punching down through the middle time, but as in March and also December last year the market failed to push down through. What was interesting back then at the end of April was how when the prices reverted back up, indeed gapping higher, they still only managed to make a lower high than in April proper, and also in March. The action created an island top centers around the moves from 4 weeks ago. The gapping fall made 2 weeks ago was the start of the most concerted attempt to move below the middle time. Last week it looked like the market properly exploited the move lower with a gapping move lower, but no, this gapping move lower turned out to be a potential tweezer bottom based on the January 2021 low at 32.51, and we saw prices rise back up over the June 2021 low at 33.26. Yet despite this, the rise stalled ahead of the low seen in the 34.50 to 3500 area from 2 weeks ago. This is the mildest of resistances and lays a question mark over the whole move up. Thus my detailing some of the interesting past price actions below is still valid. Hence, in November 2020 we had a gap between 31.65 to 31.88. This was partially filled back in September last year, but it's still an open gap, if smaller. Then in October 2020 we had two gaps in the same month. Gap A is from 30.53 to 30.37 and gap B is from 29.39 to 29.14. Both these have not been filled in, of course. I should now remind you that the market is currently sitting in between the overhead middle time and the lower time. The lower time is actually at 29.38 of the bearish shift pitchfork. So it'll be interesting to see if the potential tweezer bottom will, after all, turn prices higher, or if the market will try lower and fill the gaps on the way down to the lower time. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.